Ever wondered how to get rich by investing in 2024? Well, Warren Buffett, one of the world's greatest investors, has shared timeless advice that can help anyone grow their wealth. In this video, we'll dive into Buffett's top investing tips that you can use to build a prosperous financial future. From avoiding common pitfalls to seizing golden opportunities, we'll cover everything you need to know to invest smartly. Welcome to No Money, your go-to channel for financial wisdom. Stay tuned, and let's uncover the secrets to investing like Warren Buffett. Number 1. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Warren Buffett's first rule of investing is deceptively simple yet profoundly important. Never lose money. This might sound obvious, but it's a principle that many overlook. The key takeaway here is to prioritize preserving your capital over seeking high returns. By focusing on avoiding losses, you position yourself to benefit from compounding gains over time. For example, if you lose 50% of your investment, you need a 100% gain just to break even. This mindset shifts your approach from seeking risky, high-reward investments to choosing safer options with steady growth. Buffett suggests that the best way to build wealth is to protect what you have and let it grow slowly but surely. Number 2. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett advises buying high-quality companies even if they're not at rock-bottom prices. Wonderful companies, those with strong business models and competitive advantages, tend to perform well over time. These are businesses that can weather economic downturns and continue to thrive. Buffett's investments in companies like Apple, Coca-Cola, and American Express highlight this principle. These companies have robust economic moats, meaning they have a significant advantage over competitors. While their stocks might not always be the cheapest, their long-term potential makes them worthwhile investments. Number 3. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. When great investment opportunities arise, you need to act decisively and invest heavily. Buffett emphasizes the importance of seizing these rare moments. During market downturns, when prices are low, it's time to buy big. Buffett follows this strategy by accumulating cash during prosperous times and deploying it aggressively during market crashes. This approach allows him to buy valuable assets at discounted prices, setting the stage for substantial future gains. Remember, when the market presents a golden opportunity, don't hesitate, act boldly. Number 4. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. Buffett's advice here revolves around contrarian investing. When the market is euphoric and stock prices are soaring, it's time to be cautious. Conversely, when fear grips the market and prices plummet, it's an opportunity to buy. This principle was evident during the early 2020 market crash triggered by the COVID-19 pandemic. While many panicked and sold their stocks, savvy investors took advantage of the low prices. By buying during times of widespread fear, they positioned themselves for significant gains when the market rebounded. Number 5. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Buffett believes that successful investing hinges more on temperament than intelligence. Staying rational and disciplined, regardless of market sentiment, is crucial. Instead of following the crowd, investors should make decisions based on solid analysis and long-term thinking. Avoid getting swayed by the latest market trends or emotional reactions. Focus on understanding the businesses you invest in and making decisions that align with your investment strategy. This level-headed approach will help you navigate market volatility and stay on track to achieve your financial goals. Number 6. The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. Patience is a virtue in investing. Buffett likens the stock market to a baseball game where there are no called strikes. You don't have to invest in every opportunity that comes your way. Instead, wait for the right pitch, the investment that meets your criteria and offers a favorable risk-reward ratio. Buffett advises against making impulsive investment decisions. Take your time to research and understand the opportunities. Only invest when you find a company or asset that you truly believe in and that aligns with your long-term strategy. Number 7. If you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds. For those who enjoy and have the time to research individual stocks, Buffett encourages it. However, for the majority who don't, he recommends a simpler approach, dollar cost averaging into index funds. This strategy involves regularly investing a fixed amount of money into a broad market index fund, regardless of market conditions. This method reduces the impact of market volatility on your investments and ensures you buy more shares when prices are low and fewer when prices are high. Over time, this can lead to substantial growth without the need for constant market monitoring. Number 8. You don't get paid for activity, you only get paid for being right. In investing, activity doesn't equate to success. Constantly buying and selling stocks can incur high transaction costs and lead to poor decision-making. Instead, focus on making well-researched, thoughtful investments and holding them for the long term. Buffett's success comes from making a few well-considered investments rather than frequent trading. The goal is to be right in your investment choices, not to be active in the market. Let your investments grow and compound over time. Number 9. At the business school, I tell them that they would all be better off if when they got out of school somebody gave them a card with 20 punches on it, and every time they made an investment decision, they used up a punch. Buffett uses the punch card analogy to emphasize the importance of making each investment decision count. If you could only make 20 investments in your lifetime, you'd be extremely careful and thoughtful about each one. This mindset encourages investors to do thorough research and only invest in businesses they understand and believe in. By treating each investment as a precious opportunity, you're more likely to achieve better long-term results. Number 10. After all, you only find out who is swimming naked when the tide goes out. This colorful metaphor highlights the importance of being prepared for market downturns. During bull markets, it's easy to overlook risks and feel invincible. However, when the market turns, those who aren't well prepared will be exposed. Always ensure your portfolio is resilient and diversified to withstand market volatility. Don't be caught off guard when the market takes a dip. By maintaining a balanced portfolio, you can protect yourself and continue to grow your wealth even during tough times. Warren Buffett's investing principles offer valuable guidance for anyone looking to grow their wealth. By prioritizing capital preservation, seizing opportunities, and maintaining a disciplined approach, you can achieve long-term financial success. Remember, investing is a marathon, not a sprint. Stay patient, stay informed, and stay invested. Thank you for watching No Money. If you found this video helpful, don't forget to like, share, and subscribe for more financial wisdom. Let's continue to learn and grow together on this journey to financial freedom. See you in the next video.